This is Peter Lynch, a Wall Street legend who turned $18 million into $14 billion as the manager of the Magellan Fund, getting an average annual return of 29.2%. He also wrote these 3 books, but if you're too lazy to read them, you can listen to them using today's sponsor, Audible. I mean YouTube, by simply searching the book titles. But if you're still too lazy to listen to 3 audiobooks, here's his most important rule for investors from his 3rd book, Learn to Earn. Because if you understand what Peter Lynch means when he says this...
And the key organ in your body in the stock market is your stomach. It's not the brain.
And you listen to him for the next 5 minutes, you're going to perform way better than 99% of other stock market investors. So with that said, let's see what Peter Lynch has to tell us, and I'll catch you guys all next time with more financial shenanigans.
Stocks are likely to be the best investment you'll ever make, outside of a house. 10 to 11% a year is what you can expect for a total return from stocks on average over the very long term. When people consistently lose money in stocks, it's not the fault of the stocks. Stocks in general go up in value over time. In 99 cases out of 100, when investors are chronic losers, it's because they don't have a plan. They buy at a high price, then they get impatient or they panic, and they sell at a lower price during one of those inevitable periods when stocks are taking a dive. Instead, you need a plan. It should be for the long term. Have you heard the old expression, time is money? It ought to be revised to, time makes money. It's a winning combination. Let time and money do the work while you sit back and await the results. People who need to pull their money out in 1 year, 2 years, or 5 years shouldn't invest in stocks in the first place. There's simply no telling what stock prices will do from 1 year to the next. When the stock market has one of its corrections and stocks lose money, the people who have to get their money out will be going home with a lot less than they put in. 20 years or longer is the right time frame. That's long enough for stocks to rebound from the nastiest corrections on record, and it's long enough for the profits to pile up. After 20 years at 11%, an investment of $10,000 is magically transformed into over $80,000. But to get that 11%, you have to pledge your loyalty to stocks for better or for worse. This is a marriage we're talking about, a marriage between your money and your investments. You can be a genius in analyzing which companies to buy, but unless you have the patience and the courage to hold on to the shares, you're an odds-on favorite to become a mediocre investor. It's not brain power that separates good investors from bad, it's discipline. Stick with your stocks no matter what. Ignore all the smart advice that tells you to do otherwise, and act like a dumb mule. That was the advice given years ago by an ex-stockbroker, Fred Schwed, in his classic book, Where Are the Customer's Yachts? And it still applies today. People are always looking around for the secret formula for winning on Wall Street, when all along it's staring them in the face. Buy shares in solid companies with earning power, and don't let go of them without a good reason. The stock price going down is not a good reason. It's easy enough to stand in front of a mirror and swear that you're a long-term investor who will have no trouble staying true to your stocks. Ask any group of people how many are long-term investors, and you'll see a unanimous show of hands. These days, it's hard to find anybody who doesn't claim to be a long-term investor. But the real test comes when stocks take a dive. Nobody can predict exactly when a bear market will arrive, although there's no shortage of Wall Street types who claim to be skilled fortune tellers. But when one does arrive, and the prices of 9 out of 10 stocks drop in unison, many investors naturally get scared. It's at this point that large crowds of people suddenly become short-term investors, in spite of their claims about being long-term investors. They let their emotions get the better of them, and they forget all the reasons they bought stocks in the first place. Their own shares in good companies. They go into a panic because stock prices are low. Instead of waiting for the prices to come back, they sell at these low prices. Nobody forces them to do this, but they volunteer to lose money. Without realizing it, they've fallen into the trap of trying to time the market. If you told them they were market timers, they'd deny it. But anybody who sells stocks because the market's up or down is a market timer for sure. A market timer tries to predict the short-term zigs and zags in stock prices, hoping to get out with a quick profit. Few people can make money at this, and no one has come up with a foolproof method. In fact, if anybody had figured out how to consistently predict the market, his name or her name would already appear at the top of the list of the richest people in the world, ahead of Warren Buffett and Bill Gates. Try to time the market, and you invariably find yourself getting out of stocks at the moment they've hit bottom and are turning back up, and into stocks when they've gone up and are turning back down. People think this happens to them because they're unlucky. In fact, it happens to them because they're attempting the impossible. Nobody can outsmart the market. People also think it's dangerous to be investing in stocks during crashes and corrections, but it's only dangerous if they sell. They forget the other kind of danger. not being invested in stocks on those few magical days when prices take a flying leap. It's amazing how a few key days can make or break your entire investment plan. Here's a typical example. During a prosperous 5-year stretch in the 1980s, stock prices gained 26.3% a year. Disciplined investors who stuck to a plan doubled their money and then some. But most of these gains occurred on 40 days out of the 1,276 days the stock market was open for business during those 5 years. If you were out of stocks in those 40 key days, attempting to avoid the next correction, your 26.3% annual gain was reduced to only 4.3%. So to get the most out of stocks, especially if you're young and time is on your side, your best bet is to invest money you can afford to set aside forever. Then leave that money in stocks through thick and thin. You'll suffer through the bad times, but if you don't sell any shares, you'll never take a real loss. By being fully invested, you'll get the full benefit of these magical and unpredictable stretches when stocks make most of their gains.
And the key organ in your body in the stock market is your stomach. It's not the brain.